Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hi, I'm Casey McLean, Portfolio Manager for the Australian High Conviction Fund, and I'll be your host for today's podcast. Well, we've just had enough time to catch our breath from what can only be described as a pretty manic reporting season. Volatility was definitely the name of the game, and boy, was it a wild ride. It was probably the most volatile reporting season we've seen, and there was more than our fair share of carnage, and unfortunately much more downside than we saw upside in terms of surprises, with subpar results really taking a big hit. We also saw huge disparity in results, both across the market cap spectrum and within sectors. And potentially, we saw the first signs of sector rotations, with bank valuations peaking out, and some of the market's darlings from previous periods also declining on what were pretty decent results. So to discuss this and more, I'm delighted to join me Clare Coleman, who's the Australian Tech and Diversified Financials Analyst, and Sam Heithersay, who's the Australian Mining Analyst. Thanks for joining me, guys.
No worries, guys.
No worries.
But before we dive into the reporting season, let's set the scene with a few observations. As I said, it was a pretty weak reporting season, with earnings estimates downgraded by about 1.7%. with costs being the key source of downside surprise there. And volatility was definitely heightened. Some of our numbers we've put around this suggests that there was about 16% of the companies that reported in February saw a move of plus minus 10% on the day of their result. And 60% of these moves were to the downside. And if we compare that to the previous reporting season in August, which at the time we also thought was extremely volatile, there was only 10% of companies reporting that had a 10% move. And actually the split was fairly even between the up and downside moves. And also to highlight the amount of dispersion that we saw, there was quite a few sectors where we saw more than 20% moves between stocks within sector. For instance, in insurance, QBE and IAG saw a huge move. Even in banks, CBA and Bendigo Bank saw big divergence. And in retail, Harvey Norman and Super Retail. Claire, turning to you, have you seen similar trends in the tech sector during reporting?
Yeah, definitely. I guess tech being a high beta sector, we typically always see huge moves in reporting season. This reporting season was no different, and even more volatile again, overlaying some of the corporate activity and corporate governance concerns, which also came through in reporting season. But heading into reporting season, we're kind of at an interesting point in tech more broadly, where large cap tech was very expensive versus small mid cap tech. And so during reporting season, we're probably more incrementally bullish on smaller mid-cap tech than the larger cap names. And reporting season was a good opportunity for those smaller caps to come out with positive updates and re-rate closer towards their larger cap peers. And we did see some of the heat come out of those larger cap multiples. So now we're seeing a bit more opportunity actually present itself at the large cap end.
And one of the big events during reporting season was Domain receiving a takeover bid from CoStar. Did that come as a surprise to you?
Yeah, definitely came as a surprise. Our thesis on that stock, though, has always been that it's got valuable assets. They're under-monetizing, under-earning in Australia, and globally classifieds are attractive assets to both private equity and strategics alike. And you had seen a bit of corporate activity from CoStar in particular in preceding years. But yeah, definitely came as a surprise. What's interesting to come from that, we obviously sold some of our stake in Domain through that CoStar transaction, but more broadly from it, we're finding it attractive to classifieds like Seek, REA, car sales, and the implied multiple for those businesses. Car sales in particular, it's a number one in its vertical, got some really attractive businesses globally in the US, Brazil, Korea, and here. and the implied multiple versus Domain, which is a number 2, is looking really reasonable. So I think it's also throwing up more interesting opportunities, and there should be more to come, I think, in that space.
And it's a playbook that CoStar have done before.
Yeah.
Do you think it's going to change the landscape within property classifieds in Australia?
I think longer term, it's really, really hard to displace the incumbent number 1 in classifieds, whether it's property or any of the other verticals. It's notoriously difficult, and the winner tends to take all in those verticals. That's not to say that they're going to not make life difficult for REA. You know, they've got a really emboldened founder running that business who's keen to, you know, at least make REA's life harder and pour a lot of marketing dollars into Australia. But yeah, I think it remains to be seen whether they actually take share from REA. I think what you're more likely to see is that Domain has been ceding share over a number of years to REA, and potentially that just stabilises.
Right. And you mentioned corporate governance concerns popping up over the month. Wisetech, which is a significant holding in some of our funds, was case in point there. How did that perform over the month?
Yes, that was an underperformer this month. Obviously, on the corporate governance front, the result itself was clean, no issues with the fundamentals. But yeah, you saw a couple of days prior to the result announcement, all of the independent directors saw themselves in an untenable position and have left the board, which leaves Wisetech in a really difficult situation from a corporate governance perspective, where we don't have an independent board. And I think it brings to bear the fact that this is a founder-led, founder-run, founder majority-owned business. And so we're very much minority shareholders in that equation.
Yeah, being founder-led, you can have pros and cons, obviously. They're very well incentivized, but can also run the company for their own benefit in some respects. But I guess you can't dispute Richard White's success in the past. It's a high-quality company, and they've got a great growth opportunity ahead of them still. And Sam, turning to you, in mining land, we're seeing a lot of volatility as well. What's driving that in your sector?
Yes, not to be outdone, the mining sector certainly contributed some volatility to this reporting season. It's normally twice as volatile as other sectors, but we certainly saw some significant one-day moves. BlueScope was up 13% on the day. Mineral Resources was down 20%. But in aggregate, I think the sector had net downgrades, and this would have been the 6th reporting season we've seen in a row of those net downgrades, which is why it was down 3% in the month versus the market of 4%. Now, why might that be? Most of it was driven by commodities. Ultimately, we've seen half-on-half pricing in commodities like iron ore, coal, nickel, lithium decline. The one positive outlier, of course, was gold. But in aggregate, we saw enough price declines to drive some of those earnings downgrades. And the 3 other themes that I would pull out from the reporting season would be cost inflation. Cost inflation has peaked, but it's still persistent. I think as a market, we're still trying to understand what normalized cost inflation looks like after the post-COVID peaks of 21 and 22. And miners certainly called out less inflation in diesel, energy, even refining costs for metal. But what was persistent was labour inflation, and that continued to pressure margins. So we may not be at the teens inflation rates that we saw previously, but we're still hovering around 4%. The second point and theme I would extract is that of CapEx. And we are seeing the majors, in particular Rio and BHP, in a reinvestment cycle, and the market is coming to terms with that. Ultimately, BHP and Rio are aiming to invest their iron ore cash flows, which are responsible for about 3/4 of their earnings, into offshore copper and, in Rio's case, lithium expansion projects. What does this mean? It means that CapEx is elevated. It was 5 to 6 billion for these names about 10 years ago. It's now more like 10 to 11 billion. That means that net debt is at the top end of the range as well. And as a result, we saw lower dividends. In the case of BHP, it was the lowest dividend in 8 years. For Rio, it was the lowest in 7 years. And then the third theme I would extract is just a general rotation that we observed from banks to miners that benefited miners despite these earnings downgrades that we observed.
Yeah, you mentioned gold, and it's often a beneficiary of volatility or uncertain times, and the gold price is at close to record highs. Can it keep performing from here?
Gold has certainly benefited as a safe haven trade, both last year and year to date this year. As you say, it's just off all-time highs. Its sustainability is definitely the key question right now. And as we look to global uncertainty, you can see why that might persist, but it's had a very good run. And I'm much more focused on the equities. And what I would say about the equities is that they have generally lagged the physical price. Now, part of that is because central banks and retail are buying physical gold rather than equities, and that's driving up the gold price, but not necessarily rewarding stocks. I would also say that investors are looking at the transmission of higher gold prices to free cash flow for gold miners. And so we have to assess each miner to see if we're ever going to see that free cash flow. And some of them are just in reinvestment cycles. Some of them need to buy more assets to extend resource and reserve life. And so there's a real question mark as to whether we'll see the free cash flow that high gold prices would necessarily imply, which is perhaps why we haven't seen the performance we would expect with the gold price. So I don't know whether the gold price run we've had is sustainable, but I'm more focused on the equities and really focused on where we'll see the free cash flow coming through and to see who benefits from the gold price rally we've observed.
Yeah, and one question I get a lot from our investors is the question about the banks and comparing them to the resources sector and trying to understand what's driving the strong rally in the banks over the last year or two even. And we've long been of the opinion that banks' valuations and fundamentals are disconnected, and we're seeing pretty anemic growth in the banks and long-term declining returns. And perhaps this reporting season brought that to light. CBA reported some pretty good set of numbers, but Westpac, ANZ, NAB, and particularly Bendigo reported really quite weak results, and the sector sold off quite sharply on the back of that. I guess it comes to show you how just small changes in sentiment can lead to big changes in the market when valuations are stretched. So, Sam, I guess the question to you is this the beginning of that big rotation out of banks and into resources? And how important is the China outlook in that rotation?
Sure. Well, from a mining perspective, I would say I'm not seeing necessarily the reasons for miners to become the sector leaders, but as much as I'm seeing reasons for banks to lose their sector leadership. And we know that banks have had a very good run. They're up 30% last year. They're up another 9% year to date just before reporting season. But as you mentioned, the first signs of slowing EPS momentum saw them give back most of those year to date gains. Miners didn't necessarily outshine banks during reporting season for the reasons we've discussed. Cost inflation was persistent. There were headwinds from commodity prices and reinvestment cycles. But the multiples are certainly less demanding. It was in mid-23 that banks and miners were around 12 to 13 times PE. Banks closed in on 20 times, whereas miners have stayed pretty much where they are. So there's undemanding multiples in miners, which may allow them to outperform even in a fairly subdued commodity environment. But I think the key difference in that is the role of China, as you mentioned. Clearly, banks were probably beneficiaries of investment in Australia that didn't necessarily carry the China risk that miners carry. But that goes both ways. And if we are starting to see some stabilisation in China in the property market, and we had their annual parliamentary meeting just last night where they reinforced a GDP target of 5%, miners will certainly benefit more so than banks in that scenario. And so I think while miners don't necessarily deserve to gain sector leadership from banks, judging by this reporting season, they do have an undemanding multiple and they are well positioned for any recovery in China. And so, yes, it could just be the beginning of the sector rotation if we see that recovery play out.
Yeah, great. And I guess it does seem that China is getting less bad. Like you say, property prices have started to stabilise. They've stopped declining, at least in Tier 1 and Tier 2 cities. Consumption seems to be improving, and maybe it's only in the products that are receiving trade-in policies and subsidies, but it seems to be widening out. And as you said, there are slowly inching in more stimulus into the economy. I think one of the numbers I took out of the two sessions this week is that there'll be an additional 3.6 trillion RMB in fiscal spending this year versus last year, which is equivalent to 2.3% of GDP. a fairly large number, but it's still incremental stimulus. And I guess it is China perhaps keeping some powder dry in case trade wars intensify. And I guess that plays into that sentiment that we talked about. Sentiment and positioning in the banks was pretty extreme, positive, whereas in resources it was the opposite. I think most people are very pessimistic. Yeah. And another key event during the month was the RBA cutting rates for the first time in 3 years. And some of the observations I saw during the month and reporting season was that property prices have already turned nationwide. They were up in January. Perhaps the buyers trying to front run the RBA there. And even Melbourne, which has been the weakest, saw growth for the first time in a while. And a lot of the companies exposed to the housing cycle and interest rate cuts reporting pretty solid outlooks, the likes of Harvey Norman and Temple and Webster and REA, Clare, in your space, showing strong sort of listings growth. How does that affect the other sector that you cover in diversified financials? Is it having any impact on investor sentiment and fund flows?
It's an interesting one in defence. So within the asset managers, you've got Pinnacle that's actually quite bullish on the flow profile into this year. They are mentioning that they're seeing a bit of a rotation from growth into value, but net flows actually remain really strong and investor sentiment remains strong. But then on the other end of the spectrum, you've got asset managers like GQG, which are a little bit more cautious and are noting that in a period where they would typically do 1-2 billion plus in net flows per month, that's kind of coming off the boil, which I think probably dovetails into what Pinnacle are seeing, a bit of a rotation out of growth quality into value. And so investors are there, but they're rotating at the edges.
And then maybe switching gears to the growth outlook going forward. And there was some interesting data out in Australia this week as well that the December quarter GDP showed 0.6% growth, the fastest since December 22. And also, and probably more importantly, that GDP per capita rose by 0.1%, which is the first rise in 7 quarters. But conversely, on the other hand, we showed that the earnings season, we saw earnings cuts and actually growth for the Australian market pushed out. So we're seeing conflicting signals. I guess from my perspective, that is probably a large part to do with the uncertainty in the global environment. But an interesting point that I pulled out from a lot of company reports over the month was that there's even big divergences developing within the Australian economy. A lot of companies called out weakness in Victoria as a drag on their results. CBA said it's a disproportionate share of their non-performing loans. Stockland is having weak property sales there, and it's the only state where they're offering rebates. And Coates Hire, which is owned by SGH Group, said that they're seeing lower projects, deferrals, and they're having to reallocate, take their equipment out of Victoria into other states. But probably most interesting was actually Monash IVF, who said that Victoria is the weakest market for them, for IVF patients as well. So it seems to be pretty broad-based, and it seems that Victoria is the new New Zealand in the weakness that people are calling out. So, given this volatile and uncertain outlook, Sam, what is the growth outlook for the companies within your coverage?
Well, I think it's challenging because they're exposed to global trade uncertainty brought about by US tariffs and the retaliatory tariffs that we've seen. If tariffs generally threaten global growth, and that threatens the prices of commodities. So they're going to be facing that headwind. That's important for Australian growth. Mining accounts for 15% of GDP, but it's more like 20% of growth over the last 10 years. So it's very much an important sector. What I would say, though, is that we are much more positioned towards China than we are the US. And so that point you made earlier about any stimulatory response from China to face the trade war that might be arising with the US will have significant implications for Australia, perhaps more so than the US tariffs themselves will. China is our first trading partner, US is our third, and China is clearly a key part of our exports. So the US tariffs are generally bad for growth and therefore commodities and therefore mining. But if China chooses to respond to any trade war with stimulus, that could benefit Australia and Australian miners disproportionately. And as we discussed, there's undermining multiples there already. So I think they are well positioned. if we do see any trade war and stimulus response. But broadly, tariffs are generally bad for global growth, and so the outlook is certainly clouded.
Right. And Claire, I guess the tech sector has very different backdrop. Multiples are pretty stretched in some cases, probably not as exposed to the global growth cycle as commodities at least. How do you see the outlook in the tech sector?
Yeah, agreed with that. The beauty of tech, I guess, is that it's not completely decoupled from the broader macro, but there are strong, enduring structural tailwinds that underpin a lot of these businesses. So you don't really need to get the cycle bet right to own these names on a 5-10 year view, which is why we've owned a lot of them for the long term. You can own them through the cycle. So the more cyclical companies that I cover would be in the online classified space, companies like Seek, which are exposed to the job ad volume decline, which has continued over the last 18 plus months. But there we're actually seeing signs of stabilization. And for the first time, kind of this reporting season with Seek, management were confident enough to call that one stable. New Zealand is their really particularly weak spot for them, but ANZ more broadly, we've definitely moved past from bad to less bad there from a cyclical perspective. But yeah, in terms of the software names like Wisetech, Xero, Tech One, there's still so much white space those companies are going after, and they're much more product-led growth companies where it's a more important consideration, particularly for things like Wisetech, to think about in the next few years, the new product that they'll be taking to market and the things like container transport optimization and getting conviction on that rather than thinking about what's happening from the cyclical perspective.
Great. Well, thanks to Sam and Claire. We've survived another reporting season. It was one with tremendous volatility and probably volatility that's not going to subside anytime soon with the amount of geopolitical uncertainty, perhaps sector rotations within the market. But they're precisely the conditions that throw up the best opportunities for active managers like us. So thanks for joining us and see you next time.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.